Welcome to the presentation on inventory. This is the first reading in study session 9. Let us start by talking about the concept of capitalizing. The basic idea is simple. When you spend money on inventory or on fixed assets, if you create an asset, then we say we have capitalized the cost. So say in 2010 you buy inventory worth $2 million, and let's say that this happens in December. You have bought this inventory in 2010 with the intention of selling this in 2011. Clearly it does not then make sense to expense or show this 2 million as an expense in 2010, even though you have spent the cash in 2010. So what we do is capitalize the inventory. So we create an asset called inventory and assign that and say that the asset is worth 2 million because that's how much we spent on inventory. And in 2011, when we sell this 2 million worth of inventory, then we recognize the expense in the form of cost of goods sold. So we will see this again in the next reading, but what you need to memorize and remember is that when we say expense has been capitalized, that means that we've created an asset so that the expense can be recognized at a later point in time. Not everything is capitalized. There will be certain expenses such as electricity bills and so on, which you just expense when incurred. So if in December 2010 you had an electricity bill worth 10,000, it makes no sense to capitalize that, so you will simply show the expense of 10,000 in 2010. As I have already mentioned, by capitalizing inventory, we basically defer expense recognition to a later point in time when the inventory is actually sold. Now, in the context of inventory, most costs are capitalized, but some might also be expensed. So you need to understand this distinction very well because this is a high probability exam question. So let's say that when you buy inventory in 2010, so let's say all this action is happening in December 2010. You buy inventory worth 2 million, and then cost of conversion would apply when you are manufacturing some inventory. So if you are manufacturing chairs, then the cost of conversion would imply the cost of making the chairs. So the cost you incur to make the inventory is also part of what is capitalized. So to make this simple, let's say that the cost of purchases refers to the raw material, and let's say that the cost of conversion, it costs another 3 million to convert your raw material into the finished goods, then a total of 5 million is capitalized here. Now, allocation of fixed production overhead. So let's say that we are talking about product A, and your overall production overhead is, let's say, $3 million. Of this 3 million, let's say that 1 million can easily be allocated to product A. So clearly in your environment, 3 million out of the 3 million overall production overhead costs, 1 million can be allocated to product A, and assume that the earlier figures are all for product A. Production overhead of this 3 million, you can allocate 1 million to product A. Let's say 1 million goes to other products and 1 million cannot be allocated. So the part that is capitalized is this 1 million that can be clearly allocated to product A. And then cost necessary to bring inventory to its present location and condition. So let's say once product A is manufactured, it then needs to be transported to the showroom. So the cost of transportation, let's say, is 50,000. Then this cost of transportation to its showroom destination also is capitalized. So in our simple example, the cost of making product A, let's say that product A is a plane, the total inventory cost that is capitalized would be 2 million, which is the cost of raw millions, 3 million, which is the cost of conversion, the allocated part of the overhead, which is 1 million, so we are now at 6 million, and 50,000 to transport. So 6 million 50,000 is how much you log your, that's the value of your inventory on your balance sheet. Now expenses that are classified as period costs would simply be expensed in the period incurred, and here you are not adding them to the asset value. So the unallocated portion of fixed overhead, so that's the 1 million from up here, abnormal wastage of materials, labor or overheads. So let's say that you were part of what you were making, so let's say that if you are making chairs and some chairs are just scrapped in December 2010, then all the costs associated with the chairs that were scrapped will also be logged as period costs. The logic is straightforward. Since you will not be selling those chairs because they are defective and you are simply scrapping them, it makes no sense to capitalize into an asset because you will not be benefiting from them in the future. Storage costs. So once you have your inventory in the showroom, the storage costs, let's say, are $10,000 per month. Those storage costs cannot be expensed. Those storage costs cannot be, you do not capitalize them. Administrative costs, such as the cost of security personnel, administrative staff and so on, also would be considered period costs and hence cannot be expensed. And finally, selling costs are also going to be period costs. Understand the distinction between capitalized costs and period costs. This is important. Inventory accounting methods. So the cost flow method is selected to allocate inventory cost for the period to the income statement and the balance sheet items. So let me just explain the logic of this and introduce you to a few basic terms. But the idea is this. Let's say that when you are buying inventory, let's say that you are in the business of trading chairs, and you simply buy them and sell them. So it is possible that when you bought your first chair you paid $10, the second chair you paid $11, the third chair you paid $12, and so on. So prices are rising. So this was your purchases. Now when you start selling, all these chairs, let's say, are identical. When you sell your first chair, what will you say the cost is? Will you say that the cost is 12 because that is what you bought your most recent chair at, and that also represents the current price of chairs? So is it 12, or do you say that that the cost is 10, or do you take the average cost, which is 11? And here is, when we say cost flow method, this is what we are talking about. So which method do you use? And for your benefit, there are 3 or 4, actually there are 4 methods that you need to be aware of, and each one of those has a name. The 4 methods that we will be talking about in some detail in the next few slides are LIFO, which stands for last in first out. So this method basically says that the last item that you got is the first one that you sell. Now this does not mean that you are actually selling the last item, this simply means that the cost assumption that you use is based on the cost of the last item. So in any case, the four methods are LIFO, FIFO, weighted average cost, and specific identification. We'll talk about these in some detail shortly. Firms can use one or more cost flow method but must employ the same cost flow method for inventories of similar nature and use. So if a firm has decided to use the first in first out method for chairs, then it needs to be consistent about using this method for all chairs. It can have a different product line for which it makes more sense to use the weighted average cost method or the specific identification method, but the point here is that there should be consistency. So for similar items, the firm must use the same cost flow method. So now, as promised, we will get into details of the four different methods. Let's start by talking about specific identification. Each unit sold is matched with the unit's actual historic cost. This is appropriate when the inventory items are not interchangeable, commonly used by firms with a small number of costly and easily distinguishable items in inventory, such as jewelry and automobiles. So let's just take a jewelry example. Let's say that you are a very specialized high-end jewelry retailer. So now you are selling each inventory item of yours is probably worth thousands of dollars, and every item is clearly distinguishable. So you will have your item numbers like 001, 002, 003, etc. And each item will have a cost associated with it. And the point is that when you sell a given item, so when you sell item 1, you know that you are selling this item and the cost of sales for that item will be 50,000. When you sell item 3, then the cost of sales associated with that item is 80,000. So specific identification, as you see, makes sense when you have a few distinguishable items and typically items that are quite costly. The FIFO method. In this method, as we briefly spoke about earlier, the first item purchased is assumed to be the first item sold. Now here again the emphasis is on assumed, because this doesn't mean that you are actually selling that first item. It simply means that you assume you are selling the first item and using that cost. So FIFO COGS, cost of goods sold, is then based on the earliest purchase cost. So going back to my simple example earlier, say you are buying and selling chairs, and the first chair you bought was for 10, second for 11, third 12. So this was your purchase. So these are your purchases. Now when you sell, we assume that the first item sold in first out is you use COGS equal to 10, and then the second chair that you sell, you assume COGS is 11, and so on. Third item would be 12. So notice that in your COGS, it's based on the earliest purchase. So when you sell, the COGS is based on the earliest purchase. And if you say in a given month sell 2 chairs, the one worth 10 and the one worth 11, so you actually sold these, on your balance sheet or your inventory you will show 12. So the inventory value will be based on most recent purchases. So given this, when prices are rising, as in my example, COGS will be understated. Why is COGS understated? Because the current price of chairs, according to this example, is 12 per chair, and what have we done? We have used prices in our cost of goods sold as 10 and then 11. So our cost of goods sold will be understated, since understated relative to the current price of chairs. Earnings will be overstated, since COGS is understated, that's an expense, hence earnings will be overstated. Now, because of this, because of what we've just talked about, the FIFO method produces a more accurate balance sheet and a less accurate income statement. What do we mean by this? By accurate balance sheet, we simply mean that the values shown on the balance sheet, so in this case inventory value of 12, more accurately represents current prices, whereas on the income statement we are using prices of 10 and 11, or the cost of 10 and 11, which does not accurately reflect the current cost of buying chairs. So we have a less accurate income statement and a more accurate balance sheet. This applies also if prices are falling. So even if prices are falling, still the balance sheet will be more accurate, because it will reflect the current price even though the price is lower. But if prices are going down and we are reflecting the fact in the balance sheet, that still means that the balance sheet is more accurate. But here, so notice that in the second bullet we do not qualify with prices are rising. The first bullet over here, however, COGS will be understated when prices are rising. So what happens when prices are falling? So if prices are falling, then COGS will be overstated, and do some numbers to convince yourself of that fact. With LIFO, items purchased most recently are assumed to be the first item sold. So COGS is based on recent prices, ending inventory based on old prices. Going back to our simple example of buying chairs for 10, 11 and then 12. So that's your first chair you bought, second and third. With last in, first out, now let's say you again sell 2 chairs. You will assume that the first chair that you sell, the first one that you sell is for 12, the second one that you sell is for 11. So when prices are rising, as they are in our example, COGS will be higher and earning will be lower. So your COGS is based on what you bought towards the end. So 11 and 12. So COGS is higher and hence earnings will be lower. If prices are falling, then COGS will be lower and earnings will be higher. This method gives you a more accurate income statement, because the prices or the cost that you show in the income statement reflect more current costs, and hence the income statement is more accurate, and this applies whether prices are going up or going down. And we have a less accurate balance sheet, because on the balance sheet we are now showing inventory at 10, which does not reflect the current cost of inventory. The weighted average cost method. So the average cost per unit of inventory is equal to the total cost of goods available for sale divided by the total quantity for sale. COGS is equal to average, so then the cost of goods sold is the average cost per unit times the number of units sold. Ending inventory is the cost per unit times the number of units which remain. So continuing with our simple example, if you bought your inventory at 10, 11 and then 12, the average cost is going to be 11, and for our COGS, if you've sold these two, then we simply say that the cost per chair is 11, and on our balance sheet we will also show an ending inventory of 11. Now let's compare LIFO and FIFO, assuming inventory is either increasing or stable. When inventory is declining, then certain effects take place that are not part of the level 1 curriculum. We will deal with these in level 2. So assuming first of all that prices are rising. So what happens with LIFO method? We've already seen this, so this is essentially a quick review. So with the LIFO method and rising prices, what's the effect on the income statement? We will have higher COGS as we just saw, and hence lower net income. Effect on the balance sheet is lower ending inventory. And what I'll have you do is pause this screen, and based on the discussion we've just had, convince yourself that you understand all this. And before you move on, one final remark on this slide is that the results for the weighted average method will be somewhere in between LIFO and FIFO. Rising prices and stable inventory. So let's look at a few more variables here and how they are impacted by the choice of method. And all this higher versus lower refers to one method versus another. We've already seen that for COGS, assuming rising prices and stable inventory, with COGS we will have a higher LIFO because prices are going up, and if you are selling the most recent items first, COGS will be higher for LIFO relative to FIFO. Since COGS is higher for LIFO, the earnings before tax and taxes will be lower for LIFO relative to FIFO. The earnings after tax will also then be lower. The inventory balance for LIFO will be lower because the inventory that is left behind is based on earlier prices. So inventory is lower for LIFO relative to FIFO. Since inventory is lower, current assets are lower, and current assets minus current liabilities, our working capital is also lower. The liabilities are not impacted depending on whichever method you use. And finally, this is very important, the cash flow is higher for LIFO. Why is the cash flow higher? Because the taxes are lower. Since the taxes are lower in LIFO, the overall cash flow after tax will be higher for LIFO. And again, the weighted average costs provide results which are in between LIFO and FIFO. So the weighted average cost method would be down the middle. Under IFRS, companies can use specific identification, FIFO and weighted average cost. Notice that last in first out is not allowed according to the inventory cost method.